Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, today, guys, I'm excited to welcome Charles Carillo to the show. Charles is the founder and managing partner of Harborside Partners, and since 2006, Charles has been involved in over $200 million worth of real estate transactions. Now, he's got extensive experience in renovating and repositioning multifamily and commercial properties, while also passively investing across diverse asset classes from, just general commercial real estate to ag tech startups. Now, at Harborside, Charles oversees acquisitions, investor relations, and strategic partnerships. He's also the host of the popular Global Investors podcast, where he interviews successful investors from around the world. Now, and we'll get into this here today. Before he got into real estate, Charles co-founded an online payment processing company that went on to handle over $1 billion in payments across 5 continents. And so, really, guys, his entrepreneurial journey and diverse investing experience really give him, what I'd say is a global perspective on building wealth, scaling businesses, and creating long-term value. And so, Charles, my friend, welcome to the show. It's a pleasure to have you here.
Yeah, Kevin, thank you so much for having me on the show, and what a fantastic introduction.
Yeah, no. It's well, excited to have you here, man. You got an extensive background, so excited to talk shop. And in the 40 or so minutes that we have together, hopefully we can peel back the layers of the onion and just learn a little bit more about you and all things that you've done now over a couple of decades span of time. So how about we let's just back it up a little bit. I there towards the end I referenced that payment processing company that you had built prior to getting into real estate. So maybe tell us a little bit more about that time in your life.
Mhm.
And then, I think more specifically, would love to understand what that looked like, the transition into real estate, what that looked like, and any, key, lessons or just skill sets that you carried over from building that business, and how did that tie into real estate?
Yeah, no, that's great. So I started that about a year or so after graduating. Well, yeah, right after graduating college, I started that. It was during college, but I got into our kind of made it into more of a payment processing business after graduating college. It's still around today. I'm still a owner in it. My brother runs it, and as a partner, so we had separate businesses. And years back, we kind of consolidated them with myself kind of working mainly focusing on our real estate ventures and kind of just still overseeing what was going on with payments, but because we had built up such a business on that end. But yeah, it was it's a difficult it's a competitive industry, and we kind of carved out a niche for ourselves over the years. And then it allowed me, utilizing payment processing was something where, or having a business in general that was able to provide cash, was cash flow business, able to invest into real estate, which, as we know, anybody invests in real estate, yes, there's cash flow, but it's usually not initially. It's usually not as much as people think it is. I mean, it's really a long-term play where you're building something, and then at the end of it, we're kind of refinancing part out of it, or we're selling it to really kind of see the fruits of our labor of what we really did, that equity kind of experience it. And I found with, that was it. The payment processing, building another business was allowed me to kind of a lot of that upfront capital to invest in real estate, which was my
Mhm.
true passion, and kind of how I learned the business from my dad being an investor for probably decades before that in multifamily.
Okay, so kind of ran the blood. The multifamily ran the blood a little bit, right?
Yeah.
Okay, good deal. So is that where it started? I mean, obviously you're making piles of cash with the payment processing company. You probably need some tax write-offs as well and some safe harbors for it. And so multifamily became it. Were there any other real estate asset classes you had considered outside of multifamily, or just was that again? It's kind of in your DNA, I guess. If your father was in multifamily, so what that look like?
Yeah, I've never really been active in other asset classes within real estate. I flipped a few houses,
Mhm.
like after college. It was terrible. I just, I couldn't, the only way you can really do it, like if you ever read that book, like 10x is easier than 2x, it's completely true. Like you have to, every time I'd find the deal, I had the money, and then it's like contractors and not a whole thing. Like this whole part of executing it was always an issue, and you wouldn't have enough consistent deal flow. So when you got it, you got good deals. It was just like a whole thing. So like people, hats off to people that have built these like flipping businesses, because it's really just like a machine. You know what I mean? And you have to
Yeah.
keep on feeding that machine. And it's really, there's Which in real estate that can get a little dangerous if you start feeding the machine during, different times. And, a lot of people got eaten up during the GFC and stuff like that. But it's just, I found that as buying real estate and a longer term play, and I just knew multifamily inside and out. Well, a little bit of it at that time. Now, after years of doing it, I know a little bit more. But the thing that was that I just knew it was like a very solid. It was a great place to put capital afterwards. And I wish I knew like all the different tax. I never knew any of this stuff when I started. You know what I mean? It was just really just putting money in, having somewhere where it was like a solid investment or something like this, where you knew, okay, this money's like safe. It's going to compound a little bit. I'm going to make a little
Hmm.
bit of cash flow. And that was kind of like the goal. It was never like, you look back on it now and how technical people are that are getting into the business now that maybe have gone through like certain different coaching programs or something like this. And they like everything is spelt out. I never bought anything on tax benefits or anything like that. It was
Sure.
just like, just like buying stuff, a safe harbor to put some cash after you'd made it and, live off of a little bit of appreciation and a little bit of cash flow. Mainly when we were investing in Central Connecticut at the time, where I'm originally from. I moved down to Florida in 2012. I mean, it was really a cash flow market. So there
Hmm.
wasn't too much appreciation. You're going in there. Rents didn't grow much. I mean, we didn't have that much
Yep.
inflation either. But so it was just like that was a different way. And then coming down to Florida, it's a much different animal. You know what I mean? Where there's more appreciation. There's cash flow, but there's more appreciation. And it's a different kind of part of kind of what you're doing. And I think other people in other parts of the country that maybe are operating in that type of market as well can, understand what I'm saying.
Yeah. No, absolutely. I came from Pennsylvania, investing up there,
Oh,
probably
okay.
very similar to that of the dynamics. At least the time I was there and in buying real estate, it just very little appreciation. It was
Hmm.
definitely a 100% a cash flow game, and there was a couple properties from what I paid for them to what I sold them for a couple years thereafter. They maybe they appreciate like 2%, not much, but
Hmm.
they cash flowed along the way. Whereas down in Florida, I moved down here. Surely you could find cash flow, but it was a lot more challenging and but definitely piles of appreciation if you wanted to be speculative and take that route. So there's cash flow opportunities if you dig hard enough, but it's definitely more difficult in Florida, at least in the major markets, Tampa,
Hmm.
Miami, Orlando. Lots of different types of capital you're competing with here as well, especially when you start talking about multifamily real estate, right? You got lots of 1031 money that makes its way in here. Folks that just need a home for it, they don't even necessarily
Yeah.
care about getting a return, and it's difficult to compete when you're against that type of buyer pool. So let's um let's talk about the last couple of years. What that's looked like in your business. And I guess just for some context, when did you guys? I guess when did you found Harborside Partners? Like what year was it that you guys put that in place and started buying real estate?
I put in place in 2016. We didn't do any syndication deals until maybe 2018, 2019,
Okay.
like with investors. And we did some JV deals and we still do some. But it's really, I think it was end of 2018 or 2019 is when we did our first like syndication deal. It was in Tampa. I was living in St. Pete at the time for a few years with my now wife and did our first deal over there. And I mean, like you said, Tampa's a great market. It's just it's something that's for multifamily. It's gotten pretty expensive. And when we were buying, that's when we started raising money from investors. The first deal we did, we raised 1.8 million, which seemed like a ton of money at the time. Now it's not so much, but pre-COVID in that area of Tampa, it was
Mhm.
a lot of money to raise, and we did it. But yeah, I mean, it's difficult always with your first raise and putting investors together and putting all the pieces together to actually close on the deal. And we held that deal for 3.5 years, something like that. We sold that. And then, yeah, we've done a couple other deals in Tampa, and then right now, where our current deals are actually for syndication deals are in Atlanta and then DFW. So
Okay.
that's kind of where we are now with what we're focusing on.
So we've gone personally, and then from a company perspective, we've gone full cycle. We've gone full cycle on a lot of deals over the years, and I would say that there's a number of those deals that looking back, and surely there was a great pop, a great profit to be made. But there's definitely a number of them that I regret. I wish I would have
Hmm.
just, stayed true and held and just continued doing more cash out refinances
Yeah,
versus that of realizing, the full profit right then at that time. Cause it's done after that, right? You move on
yeah.
and obviously you reinvest that capital. But are there any regrets? We start talking about Tampa, right? Like it was much different buying environment. It was still even difficult, maybe 18 and 19, but definitely not as competitive as it got as soon as interest rates went down and just lots of capital flowing into the marketplace. So, any regrets on selling some of those earlier assets?
I think we transitioned. I think we sold our last C class property in 2023, and we've been specifically invested only in like I guess B minus B and above type
Hmm.
properties since then, which I don't regret that. I think that was a great move in the right direction for us because we got hit after a couple of years after COVID, like I think a lot of other C class operators did, with as money from COVID started drying up, and people were like, "Oh, I got to pay rent again," and going through this for several months. I mean, this was just, I don't know when was it? It was like 2022, I think, or 2021, 2022, and
When the eviction moratorium,
yeah,
finally lifted, and they, stopped handing out money, and yeah, yeah,
yeah. So that was something that was just like, that I mean, I didn't think it would be such a hit. Like we thought we'd have more of a hit at the beginning of COVID. Obviously, that was kind of smoothed out, but it had to come out again at some point, and that's when it came out. And so the better assets fared better. I think the majority of them, no. I think maybe like I had one property in Tampa I really liked. It was a part of a portfolio, but it was like a 68 unit one. I would have held on to that one. We bought it a bunch. We bought it in like 2020, right in the beginning of COVID from a group of Harvard alumni guys that like had an investing group, and just like three guys or something. And we bought it from them, and that was a great deal. I would have held on to that one and refinanced it out, but we had another couple other properties, and we sold it all as a portfolio again. But it was actually no, we sold that. Yeah, we sold it as a portfolio. We bought it separately, but one of the other things that was in that portfolio, we're just like, oh, we'll just sell it all out. You know what I mean? But that one
hmm
I would have held on to. But everything else for the most part, I would say like the transition and I think like growth as an investor, and I find this with like other investors too, and no matter what the asset classes are, you start getting into better properties, you know what I mean? Better areas. And the same thing is like when you look at institutional investors, they're not when you see what they're focusing on, it's like something 10, 15 years is old for them. You know what I mean? They're
sure,
looking for specific what it is. And when you speak to them, it's always, your collections start they always say it's like little by little your collections are start to decrease as the properties are getting older. Hypothetically, obviously, if we're talking parts of New York City or Boston, this is different. But the thing that happens with the because of the less credit tenantness
sure.
you're getting in those properties. But anyway, with that being said, I think that's kind of I think other than going into like properties like that, I mean, we just refinanced one at the beginning of this year that in Atlanta, which is a good property. I'm happy we didn't have to sell it, but we were refinancing off of floating. And I think getting longer term debt on that one, this is something that we'd want to hold longer. You know what I mean? So I think finding deals like this that actually work and that we've got extremely high occupancy in this property. It's like almost 99%, 150, 156 units, something like this. And it's just like one of those things where when we find that that's like a property, like you were saying, we refinance it and it's kind of just like printing money. You know what I
Yeah.
mean? We can do our distributions, everybody's happy, stuff like that.
So what's it look like the last couple of years? And obviously we've had some volatility with capital markets and transactional volumes down across the board. There's obviously now it looks like there's finally being, so there's some distressed deals, more of the syndication groups, maybe not the deals themselves, maybe some distress in deal because they just haven't fully executed their business plan. But what are you seeing in the multifamily space in just the last couple of years as it relates to new opportunities? Are you guys, have you actively purchased anything as of recent months or quarters?
We are working right now on a portfolio of properties, just three properties that we're working on currently. But literally over the last year and a half, 2 years, we haven't purchased anything. We sold a property last year, a deal in Tampa, and it was everything was fine. We sold at that point, but we had we had a major fire at one of our properties in Dallas that we've been focusing, and part of it 10-15% of the property was offline and still offline right now. It's something that like an
Oh,
ongoing
wow.
thing that we're working on. So anyway, with that being said, that's really where we've been like really focusing. And that's one thing I liked about kind of when I was starting Harborside, like, oh, we're going to grow this huge. We're going to like have all these people and do this. And I've kind of backed up on that a lot. And I think just having it more of like a very smaller kind of firm, I think was like it's easier that way because I don't have to get caught up in just like deals after deal. You know what I mean? You're just like, I gotta do deal, gotta do deal. As kind of like one of these larger firms that they have to branch out into different asset classes, and if you don't want to do that, then you're really just like taking one asset class, whatever it gives you. You know what I mean? In the markets
Hmm.
that you have people in, and if it doesn't really pencil, it's just kind of kind of, sharpen that a little bit more and see, make sure hopefully everything goes well. And that's kind of how we didn't want to do it. So I think what we've done is over the last year and a half, focusing specifically, like I said before, we're transitioning into only B class and above properties and, yeah, doing deals that really pencil. And I mean, we had one that was on floating. We refinanced earlier this year. It was fine. We paused distributions for a few months on that one, and that was that's a difficult decision when you're doing that with investors, but it's just something that you have to do. You know what I mean? We haven't lost money for it. We never had any properties go into foreclosure,
Well,
so
at least you had
we're
the
lucky on
opportunity
that
to
front.
refinance it. So obviously your basis was low enough and the value hadn't declined that much to where you could still do a refinance. So that's good.
Yeah.
I don't think a lot of folks are in that position where they can't even refinance if they wanted to.
No, I was really lucky that that happened, but it was one thing that scared me. What the broker said to me, he goes, "This is the only deal that was purchased in 2022 that I did that was able to get like a cash out refinance." Or you know what I mean? You're like, oh,
Hmm.
I mean, not that we got that much money in cash out, but the thing though is that kind of scares you. You're like, wow, there's like, it's still bubbling there under the surface, and
Absolutely. Yeah.
people just like, we thought this was going to be like 2025, 2024 was going to come out. And I just don't know if it like how the banks are thinking about this. If it's like we kick the can down the road until the value's up enough that I get my money back, or do we kick this down and like your investors are like out, or like you know what I mean? How long it goes that it gets pushed down? You know what I mean? So it's interesting, but it's scary. I mean, you don't really know. Like, I don't think we've seen like the extent of what's happening from those interest rates. I mean, I think a little bit's come around, but I mean, even if you got 5-year debt, you know what I mean, in 2022 or whatever,
It's coming
you were
up.
smart.
Yeah.
Exactly. Yeah. I mean, it's right around the corner.
Yeah. I guess not right around the corner, but yes.
But
Yeah.
I
Yeah.
mean, you got to start 6, 7, 8 months out trying to figure out everything like this. I mean, where's the rent increases coming? I mean, you're getting, you know what I mean? It's something like, are we right now? Everything I read is like you're getting. We haven't decreased any of our rents on one property. I mean, to get some, it's like 1 or 2%. We've been like, that's right in that area of we're raising at 1%, or some of the other ones, and some of the units we lower a couple percent, to keep the occupancy as high as possible. But I mean, over the next 18 months, I mean, are you really, if you have something in 2027 that's coming up, you know what I mean, that you're
Yeah.
preparing in the next 12 months to get prepped because it's got a season, all that paperwork. I mean, it's like, I
Have
don't
you
know,
found
it's a lot sooner than later.
Yeah, have you found your guys? So you've had some properties maybe you've had a decrease rents. It's funny because I remember having this conversation. So I went through '08 and all that and had a lot of real estate down here in Florida, and there was just a oversupply of product, and after that, over the after the next run up, the one we just kind of finished up, many conversations I got in, or this podcast I heard, people kind of preaching that, rents historically, they're showing charts of like rents have never gone down in multi or whatever it was. Pick your asset
Yeah,
class, but mostly it was revolving around single family home rents. The build to rent people were kind of touting single family home rents have never
yeah,
declined in history. Multifamily guys were touting that they've never gone down in history. And I was like, bullshit. Like I can tell you
yeah,
firsthand experience, they absolutely went down. And maybe it depends on how you frame going down, right? Like if the base rent is $1,000 a month, maybe it didn't go down to 980 a month, but maybe on the front side you gave 2 months of concession, right? To where
yeah,
to where it still
yeah,
averages out to where there was a decrease overall in that annual rent that was collected. And so,
yeah.
but yeah, we went through a number of years where rents decreased, and in some
Mm,
instances, I mean, as high as maybe even 10%, 12% in certain areas. It was pretty bloody back then, but
yeah.
um, in
But
any
the other
event,
thing people, sorry to cut you off. The other thing too, people don't realize when they're doing this is or saying this is that 2021 we had like 20% rent growth in some of these
that's right.
markets. So
Yeah,
the thing that was that
unsustainable.
if you're exactly, but it's also one of those things that if you're, I had this old real estate investor tell me one time, and he called it like the 10-year law of like real estate investing. Hold it for 10 years, the chance of like you losing money is like nil. You know what I
Hmm.
mean? So the thing is, if you're buying it over 10 years, I mean, if you dump it in 2021 and somebody buys it in 2022, maybe they're not going to, they saw this, they think it's going to continue. It's not. You know what I mean? But the thing that was that if you had that 10 years, you're probably still up. You know what I
Yep,
mean? From
I
buying it
agree.
in 2019. So sorry to cut you off.
No, no, it's fine. I mean, I mean, honestly, that's really our investment philosophy internally. I mean, we look at everything with the 10-year lens, and actually, a lot of times we look at it even further out than a 10-year lens. It doesn't mean it has to take 10 years to hit our
Hmm.
projected returns. I mean, as you know, you're almost like going the opposite direction as far as if you're like an IRR driven investor, then the longer you go, the more difficult it becomes because you find yourself in a declining IRR environment. But we have found that as long as it really debt is the one thing that can absolutely kill your deal, right? Like if
Hmm.
assuming that you bought a property and you bought a property in a good market, right? That doesn't have a declining population, or people aren't moving out of the area because there's no jobs. Assuming you did that right, and assuming that you're actually a good operator, meaning that you either yourself or you've got a great property management team and you've got a great asset manager, and you guys are keeping your finger on the ball, then the only thing that can really hurt you is debt. Is the need for you to either refinance debt, or maybe you
Hmm.
picked a floater and rates up like they did, they went up to where you're in a precarious state to where now your debt coverage is out of whack.
Yeah.
If you had, if you could hold it long enough, to your point, that 10-year kind of target there, if you hold it long enough, you've got the right debt that gives you stability. At least you don't have to go find new debt. If you can hold it long enough and ride out that wave,
Hmm.
historically, many that have built a lot of wealth in real estate will argue that you'll be just fine. But you got to be
Yeah.
able to hold on for the long term. And that's very difficult when a lot of deals that got done in the past 5 years, they were all more of a 2 to 3 year business
Yeah.
plan. Well,
Hmm.
what's plan B if 2 to 3 year business plan doesn't work out or something changes, right? And I
Hmm.
don't think a lot of folks really thought that through in its entirety. But I think it's also was driven by, the FOMO, fear of missing out. I think a lot of deals got done that folks felt of, well, that, and if I didn't buy, and I saw this leading into '08, right? And like kind of the same thing. It's like, if we don't buy now, house price, man, like things just keep going up, 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 up. If we don't buy
Yeah.
now, then, we're never going to be able to buy. And I ultimately think that a lot of syndicators made short-sighted decisions with properties they bought, investor capital, maybe even you can
Yeah.
make the pro forma say whatever you want, and one thing I
Exactly.
will guarantee you is that the pro forma, actually, no matter how good of an underwriter you are, how good of an analyst you are, I could promise you it's never going to be right.
Yeah.
It's either you're gonna exceed your expectations and it's going to outperform, or it's going to miss the expectations. Maybe not by a
Yeah.
lot, but like it's gonna, one or the other. You're never going to hit it right on the mark. So at least I haven't seen it yet.
No, no, no.
So, what are you most excited about here over the next? Give me the 2 year forecast. I mean, what
Oh
what keeps
man.
you up at night in a good way? What do you guys talk about internally? What do the future plans look like for your firm?
I mean, it was just I think like one of our partners that we work with just literally like 2 months ago came back around and was like, all right, like we're really seriously underwriting uh like acquisitions again. You know what I mean? Because we're not, we had a lot of people came to us over the last couple of years trying to find stuff that pencil, trying to make acquisition fees with development deals. Not something we've done before on an active front. I've passively invested in construction deals, development deals. But the thing though is that I just didn't, you have to prime your investors for this. And also I should know what I'm doing too if I'm taking money for this. So one of those things is I feel like a lot of people, that was the next thing to jump into, you know what I mean? Was getting into development when you can't do acquisition. And that was something we didn't get involved with. And now it's something that I mean, over the last 2 months, we've like really dramatically gotten back into acquisition underwriting. We would do deals here and there. You get deals sent to us, we review them, stuff like that. But it was just like we had like that 10, 15%, or like 15% like delta between
Mm.
where we want to buy and where people want to sell. And you're like, I mean, I understand you're doing this to like try to get made whole and all this kind of stuff and love to help you, but like this is not, it doesn't pencil, you know what I mean? And then the debt is not like, you know what I mean? The other thing too is that when you go into these situations, where it's, if you go into any type of pullback, people go, well, you can always refinance, stuff like that. The problem that happens is your values are dropping, but
Sure.
also the loan to value, the leverage is dropping too. So you have two
Hmm.
things fighting against you, even if you can maintain that. So the problem is that you might have a good asset. The problem is that if they were loaning before 80%, and now they're at 75 or 70, and it's, you know what I mean, whatever it is, and your value's gone down. I mean, now you're just like fighting an uphill battle of trying to get that thing refinanced if you need to. And it just becomes, I mean, it's something that you're not able to fight against, you know what I mean, without like putting more money into it.
Yeah, no, I agree. I agree. Well, that's exciting. No, I think there's definitely opportunity coming down the pike. We haven't necessarily seen what's been happening in multifamily. We haven't seen that in the manufactured housing space. It's been a fairly stable market. A lot of there wasn't really bridge. That wasn't a common product that we saw used a lot in our sector. And so, interestingly enough, though, is like we've actually had some great last couple of years. We've been buying quite a bit, and it's only because the competition's kind of going by the wayside. Anyone that maybe got out in front of their skis and maybe overpaid for some stuff, they've been kind of pencils down, focusing on existing assets. And so we've had a great couple of years of buying. Um, but with that being said, we have written just an exorbitant amount of offers in order to buy the deals that we've purchased because the delta between what most sellers are asking to what makes sense based on current debt and where rates are at and where LTVs are at. Like, and so maybe we'll underwrite. We'll look at 100 deals. Out of those 100 deals, we'll maybe actually go through a formal underwriting on 40 of them.
Yeah.
Out of that 40, maybe we'll make an offer on 30 because the other 10 were too big of a delta. We're like, we're not even going to insult anybody.
Yeah.
This is a joke. Out of that 30, we may buy one or two that we actually make an offer on. It's a lot of work to to turn a lot of stones over and find the diamonds in the rough. But
Yeah.
I think it's just all about perseverance. Like, I mean, you guys are still
Mhm.
looking at deals. You're still actively. You got to keep your finger in the pulse. Got to stay in the market. Got to let brokers and owners know that you're still actively buying. That you have the wherewithal to do it, and deals will come to you. I think what happens in these instances. I saw in the '08, and people that got hurt. The majority of people that got their butt kicked went and found something else to do. They
Oh,
didn't
yeah.
even try to claw back and get back into it, right? And it took me a couple years. I got my ass really kicked. It took me a couple years to actually, you know, pull my pants back up, strap on the boots again and get out there and make something happen. But a lot of folks turned and went somewhere else. So I think what we're going to see is, probably a little bit of a thinning of the herd,
Hmm.
at least of like a lot of the syndicator groups that came, on
Yeah.
the scene in the last, 5 to 7 years. Obviously, institutional groups are still in it. They're still hot and heavy on multifamily, traditional multifamily. But I do believe it will weed out a number of folks here in the coming years, and we won't see as many of the same names and faces that we saw years prior. But time
Yeah.
will tell.
Yeah, yeah. I just it's one of those things where you found a lot of these syndicators that came on that were kind of like acquisition machine type syndicators, and
Yeah,
like this was their primary income source was doing these deals and
and
generating
fees.
acquisition fees and
Yeah, yeah.
everything like that. Is when I passively invested in deals, the best deals I have are ones that are like run by like two or three like independently wealthy people. And that are
Hmm.
just like, oh yeah, we'll do one deal a year that pencils or two deals. You don't hear from them for like other than your updates, you know what I mean? Like 9 months, and they're like, okay, we have a deal you know what I mean? And you're like, it's
Yep.
like really handpicked of what they're working on, and you're like, okay, compared to everybody got emails back in the day, it was literally like every like week, every month, you're getting stuff from people like buying this, we bought this has been funded, this is oversubscribed. They send you out the thing, and 10 minutes later, it's oversubscribed. You know what I mean? And you're like, wow, that's fast. I wasn't even didn't even check my email to see that one come through. So it's like it's just that's kind of over, like you said, it'll be thin out, I think, with people that are like true long term. And like you were saying about the real estate, bought my first deal at the end of 2006 about the GFC. I remember going back, I bought my second property at end of 2008, completely different times. And I went back to like inspectors, I went back to agents. Everybody was gone. Like gone, didn't have their licenses anymore. They were completely out of it.
Yeah.
Anybody like working in this, I think I had one mortgage broker who had like a serious book of business. He was still in it because he had like a real business and clientele. He'd been doing it for
Hmm.
like decades. But everybody else gone. And like it's just like you said, I mean, people just it's like in everything. They'll go to the next thing, whatever that hot thing
That's
is.
right.
They'll be working on that. And then when it gets really bubbly again, you'll have all these people come back in one way or another, you know?
So this is, I mean, it's a good, something for those that are listening. Like if you are, maybe you're a limited partner, maybe you're considering being a limited partner and passively investing in someone else's deals. I mean, this conversation's real. I mean, so a lot of I think potential LPs are like, well, how do I do due diligence on the
Mhm.
deal? How do I do due diligence on the partnership? And I'd say the partnership is the most important piece of it, right? Like, and if they've been around for, and I'm not just touting myself or Charles, but I'm going to do it anyway because that's what we're talking about here, and both of us have been around the block for now two different cycles, and so and we've seen what happens in those other cycles where people pack up their shop and they go do something else. But the folks that have got the grit and determination are the ones that make it through, and also that make more disciplined decisions prior to any type of correction are the ones that make it through the other side. So, no, it's just that's important to note because I mean that's really you're betting on the jockey, right? I know a lot of folks have probably heard that you're not betting on the
Mhm.
the horse, you're betting on the jockey, and like that's really you're betting on the sponsor and just looking at their track record. And what have they done? Have they lost money? Have they had deals go, back to the bank? Have they had to turn keys in? Anything like that? Have they stopped distributions? Which I'm not saying that means any one of those things on its own doesn't necessarily mean it's they do a bad job or they're a bad sponsor, but you put enough red flags together, you trust your gut, right? Like the signs are
Mm.
there in your face. So anyway, I
Yeah.
think that's just where we're at in the cycle. And now that I'm watching some deals start coming back, I'm watching some offerings come back out from a number of different groups. Some that were hot in the heyday that have deals that have gone sideways, and that's interesting to see, right? That folks that have lost quite a bit of money on other deals and they're putting out new opportunities. I'd probably have an internal struggle doing that, but hey, to each his own. Um,
Yeah.
you know,
It's
I'm
difficult.
sure I'm sure
Yeah.
they're not raising capital from the ones that they lost, from the ones that they lost their capital, but
Man, when I will touch base with people that are in like our investment club and stuff like that, and man, the some of these people got hit. Like
yeah,
I just like, and they'll mention via email like who the person was that they invested with, and you keep on seeing the same names or groups names come up, and they're like a guru or something or whatever the person was or is. And I mean, those people are, I mean, like if you have these as your investors, like one of these things, like you have to go and find new investors because people are like, a lot of those investors that got burnt, and I don't doubt, I don't,
yeah.
question them, but it's just like they're out of it. They're like, man, I lost all this money, all this kind of stuff. It's like, you know what I mean? They're just putting in money after deal, and they get one distribution, and they're back in putting more money in.
Yep. Yep. No, I agree. I agree. Well, Charles, this has been a fun conversation, my friend. Very enlightening. Appreciate you coming on, sharing your story, your background, and what you guys have going on there at Harborside. For those that want to learn more about you and your group, maybe share your website. Also, I know you've got a podcast. Feel free to plug that as well, and we'll get all that in the show notes.
Yeah, thank you. So, our website, our company is harborsidepartners.com. So if you go to harborsidepartners.com, there's a ton of information there. You have a YouTube channel. I do a weekly interview podcast. I also do one called like Strategy Saturday, where it's just like 5-10 minutes going over something specific that we're working on or something just like real estate in general, one-on-one stuff. And then my podcast is Global Investors Podcast. So all those links are on harborsidepartners.com. So yeah, take a look at it. If you're interested in learning more, join our mailing list, or get on a call with us if you're interested in investing.
All righty, fantastic. Well, Charles, appreciate you coming on the show, and guys, I'll get all that in the show notes. And that's all we have today, my friend. So I look forward to keeping in touch with you, and best wishes on the remainder of 2025, and hopefully you guys kick some ass in 2026.
Definitely. Thank you.
All righty, guys, that's all we have for this week's show. And so until we meet again next week, this is your host Kevin Bupp, wishing you huge success. Take care now.